Hello and welcome to this IGC online meeting webinar organized by Enerchange and Think Geoenergy. I am filling in for Jochen Schneider. My name is Alexander Richter. I'm the founder of Think Geoenergy and the managing director of Iceland Geothermal. And I welcome you to this webinar and presentation, which is very interesting as part of the Focus on Geothermal series. It will be recorded and will be made available on YouTube of Enerchange. You'll be able to ask questions in the chat on the side of the webinar program, and we will then try to kind of get into these questions as much as possible after the presentation. The topic today is a very interesting one, and it's naturally also a key theme of the IGC Invest Geothermal event that we've been holding already twice and will be holding again now on 17th of September. And that is about risk management of geothermal development, and a big topic in a sense of attracting funding into the sector and securing against the risk of resource development. And in that context, insurance and different programs have actually been approaches to mitigate the risk involved in geothermal. So we're pleased to have here today with us Julian Richardson, the CEO of Parhelion Underwriting. Julian has 15 years of experience in climate finance and 20 years in the and insurance sector. Recognized for his work in climate risk finance, he's also working with the UK government. And Parhelion, in the context of his work, and he will explain this in more detail, uses private sector insurance underwriting capital to support deployment of other capital that would go into the sustainable development investment opportunities. And naturally, in the context of geothermal, the option of insuring against the risk that appears in the early development. And with that, with further ado, I'll just hand it over to Julian for his presentation. Like I said, we will have the option for questions afterwards, and we will take them as they come. Otherwise, we'll engage in a discussion. Julian, with that, over to you.
Great, thank you very much, Alex, and thank you to Enerchange and Think Geothermal and IGC for putting on this webinar. Pleasure to participate. As Alex said, my company is Parhelion Underwriting. We're a risk and insurance business with an exclusive focus on climate and sustainable investment opportunities. We believe insurance has an important role to play in helping divert more capital to investments in sustainable and green opportunities. And our thesis is really, you know, the insurance is both the glue and the oil of the capital structure. It's simply true that it's not possible to invest in something if it's not insured in some way, because all the different forms of capital have different risk appetites, and the important thing is to match those risk appetites with the risk capital that's available. And those risk capitals are predominantly equity and insurance. So that's what we do. We're a regulated insurance intermediary, and we work with a range of clients, from project developers, investors, policymakers, and indeed with the multilateral development financial institutions. We have two very heavy focus on two important sectors. One is geothermal energy, and the second is environmental commodity markets. But we provide a comprehensive range of insurance products. But we're here today to focus on the geothermal sector, and anyone in the geothermal industry is probably very familiar with this chart, and this was originally developed by the ESMAP program, and it importantly maps the cost and risks associated with a geothermal project So from the left-hand side, you are right at the beginning of your geothermal project when the risks are very high, but the costs are relatively small. And as you progress along your project development pathway, the costs increase and gradually you're de-risking your project until you finally have a fully operational power project supported by geothermal energy. The bit we have focused on is the bit highlighted in the middle. And this is a particular challenge for geothermal resource development. And it's difficult because the costs are increasing at quite a rate. So you're now moving away from venture capital and some concessional financing sources. But yet the risk has not gone away, or it is still quite a significant risk. And this is where we've developed a risk finance solution to deal with this particular part of the geothermal development pathway. What I want to talk now about is the risk profiles at that point. And it's important to disaggregate exactly what we mean by that risk. Yes, it is not insignificant risk, but what do we mean by that? If we look at the risk profile here, we have a very simple profit loss risk profile, and that is of an uninsured project. And you can see as the project gets more successful, the project becomes more profitable, and the break-even point is where the red line crosses the horizontal axis. What we can do with insurance is change that risk profile to something more that looks more like this. And this puts a downside on the risk for the investors, because they are, and this is important, particularly for equity investors. And when I talked about the risk, mentioned the risk profile, what we should also think about in disaggregating it is the probability and severity. So the probability of a loss at the development drilling phase of a project is, well, you have de-risked the project to a certain extent. And so you have a reasonable degree of confidence that there is a good heat in place and good potential for a resource. However, there is a small probability of a high impact event, and that would lead to a complete loss. That kind of risk profile is fundamentally unacceptable to the sort of private equity investors that are needed to finance the large capital requirements of a resource or development drilling program. And therefore, by putting a downside on that risk profile, you make that risk more attractive to the private equity investors. Private equity generally considers breaking even to be a failure for an investment. And the risk of capital impairment, actually losing their original investment, is fundamentally unattractive. That low probability, high impact risk, however, is something that the insurance industry does on a daily basis. And therefore, matching that risk capital to the risk profile is really what we've sought to do by developing an insurance solution. Of course, someone has to take the other side of the risk transaction, and therefore you can see what the insurer's risk profile looks like by the yellow line shown on the screen. They will, if the project is successful, earn the premium that has been paid for the insurance that has been purchased. If the project is not successful, then they will suffer the downside loss. And this is really where we see an appropriate role of the insurance industry and use of insurance underwriting capital to support geothermal development projects. So what does this resource risk insurance product look like? Well, it is based on a trigger that is linked to an agreed target megawatt output from an agreed drilling program. This means that if you have a project with, say, 5 or 6 wells or 3 wells with an expected aggregate output of perhaps 20 megawatts, if there is if the drilling program is undertaken and less than 20 megawatts is achieved, you can have an agreed payout to make up for the shortfall in energy production. And it's important to note that that shortfall can be structured in different ways, and limits and attachment points can vary. So you could, for instance, have a 20 megawatt aim or expectation, and the attachment point could be 15 megawatts or 12 megawatts or 10 megawatts. This is important because that attachment point will have a significant impact on the price of the insurance. The closer you are to the expected output, the more expensive or the program will be. But if the project has the ability to absorb some of that risk, you can have an effective risk sharing arrangement. The insurance will pay an indemnity to the project company, and that indemnity can be based on potentially additional wells that are drilled to make up for the shortfall in energy. It can cover some of the existing drilling costs that have already been incurred, or alternatively it could be structured as an additional slug of equity to go into the program to enable the investors to meet their minimum IRR requirements. I mentioned a deductible and co-insurance. There will always be some form of deductible or retention of co-insurance required, but that is agreed and negotiated on a case-by-case basis. The more retention there is by the project and the investors, that can help reduce the cost of the premium. And it's important to note that, you know, what we're trying to do with this insurance is it's not trying to replace the equity. The insurance does not want to be the equity or compete with the equity. It is there to complement the equity by limiting their downside. So don't look at insurance as a substitute for equity. It is something that enables equity to be invested with greater certainty and reduced risk. The insurance policy is typically in place for the period that covers the drilling and the well testing. It's important to agree in advance what the drilling program will be, where the drilling will start and end, what the well testing protocols are, what the expected output from the well drilling program is. And with all that agreed in place, then the insurance can be put into effect, and it sits there during the well drilling program. There is time to allow for the wells to settle post-drilling, and then a testing protocol is implemented. And once that testing protocol is implemented, we have a clear understanding of whether there has been a successful drilling program, or whether the insurance pays out and is adjusted based on that megawatt output actually incurred. The wells need to be drilled in a single reservoir, and there needs to be some prior drilling experience. So this insurance is not really typical or suitable for pure exploratory wells. So we would look to have 1 or 2, possibly 3 wells already drilled to take that pure exploratory risk. We simply don't think it's appropriate to take that pure exploratory risk with an insurance program. That is pure equity risk. But those exploratory wells don't have to be full production wells, and that's a good way to limit the cost of that initial subsurface exploratory work. The wells do have to be completed, and that is something that's important for the drilling contractor and the project developer to agree the drilling program, and it's up to the drilling contractor to take the risk of completing the wells as specified. Once you have this insurance in place, as I said, it is designed to improve the risk profile, and it limits the downside for investors, and it gives them greater certainty for both the developer and the investor by reducing that downside. It also has the opportunity to improve the overall financing terms for project developers. It's reducing the cost of capital. We have even spoken to debt financiers who would consider offering debt earlier on into the drilling program, with the insurance being in place to take that downside risk. And that has a potential to significantly improve the overall cost of capital for any project developer. And ultimately, there are quite a few projects that around the world that have had significant investment in them from the project developers to cover the exploration and some development drilling costs, but are finding it difficult to move on to the next step and realize the value that they've already created by progressing along that path. And introducing this insurance can help projects move along that development pathway. Now I'd like to tell you about a fund that we are working on called the Geo Futures Fund. And this is intended to create a $150 million fund in collaboration with the Green Climate Fund, also known as the GCF. The GCF is one of the main financing mechanisms developed under the UNFCCC program to enable clean and sustainable growth in emerging and developing economies. We have been shortlisted for investment from the GCF for the Geo Futures Fund, and the Geo Futures Fund will provide a mixture of direct financing to projects, some premium finance for the insurance type structures that we have just talked about, and also some additional grant or technical assistance for the geothermal sector. It is a concessional fund, so it is not looking to make commercial returns, and that is one of the benefits of working with GCF. They have can be quite innovative and have a good risk appetite. The Geo Futures Fund actually has a long history, and it came from some work we did in combination with Geothermex and US Energy Association with funding from USAID. And for that piece of work, we did a comprehensive risk analysis and stakeholder engagement program looking at geothermal project development risk in East Africa, and also a critical analysis of all the risk mitigation mechanisms around the world, not just in East Africa. And I'm sure some of the webinar attendees will be familiar with things like GCF LAC and GRMF. These are programs that have already been put in place. And so there is what I would call a partial jigsaw of risk mitigation instruments. And the Geo Futures Fund was designed to fill in and complete that jigsaw of risk mitigation instruments, to give project developers the ability to have a clear financing path right from the beginning of a project all the way through to project completion. That work was undertaken in 2017 with the report published in 2017. In that same year, we submitted the proposal for the fund to the GCF and received GCF shortlisting in 2018. Since then, we've been working with the African Development Bank to turn this into a reality. And we're pleased to say that this year, the Geo Futures program, as part of another, in conjunction with another program we're working on, was awarded a Scale-Up Partnership Award by the P4G program. The P4G program is the Partnership for Green Growth and Global Goals. And we entered into this program in conjunction with the IGA, Parhelion ourselves, the Conservation Foundation, and our Kenyan insurance broker named Kenbright. And this is going to enable us to progress Geo Futures with the aim of having it available and operational for mid-year next year. The Geo Futures Fund is structured this way. There are two core pillars that are of most interest to the geothermal community. We are initially targeting Africa because we are working in collaboration with the African Development Bank, but we are looking at also targeting project or offering this to projects in other parts of the world. The first pillar will make direct finance available as a convertible loan instrument, and that will cover the very early stage resource development, so the surface studies. It'll cover some infrastructure costs and also exploratory drilling. That loan will be made dispersed over a 4.5-year period and will have a tenor of 10 years. So that covers really the very early stage of the project. Once you're at the development drilling, that's where the insurance program can come into place. And the Geo Futures Fund will make premium finance loans available to cover the cost of the insurance. Again, the disbursement will be up to 1.5 years, which should be more than enough to cover the drilling program, and then similarly have a 10-year payback period. There is a third pillar to the Geo Futures Fund, but that's not specific to geothermal, so we won't go into that. Just to map the pillars from the Geo Futures Fund to the cost and risk profile that we looked at earlier. So pillar 1, as I say, that will cover the surface studies, infrastructure costs and exploratory drilling. And pillar 2 will be the premium finance to cover the development drilling insurance phase. We still have some steps to take to operationalize that fund. We are targeting or focusing on Kenya and Ethiopia as a priority, but there are options to extend that to other territories. We are working with co-investors and other multilaterals to work to invest in the program. We have a pipeline of 4 deals or projects already established, and we think, as I said, it'll be middle of next year before it is operational, but we look forward to that being the case. At that point, I'm going to hand it back to Alex to see if there are any questions. I hope you found that whistle-stop tour of some risk finance options useful and interesting, and I'm happy to take any questions you may have.
Thank you, Julian. Well, there are tons of questions. Let me just kind of warn you, and I think really interesting ones as well. And I naturally have quite a few numbers of follow-up questions myself. But maybe kind of combining some of the questions that came in here and maybe working kind of the general issue of grant funding, let's say through GRMF and then the insurance product, and then maybe kind of going through to the risk insurance itself and then the funds. So I will try to kind of put these questions in that format. If you have additional questions, please add them in there, and I will kind of try to go through them in a bundled format. So Julian, very briefly, you mentioned that the GRMF and other similar programs. Maybe kind of briefly from your experience, kind of how have they been successful in a sense of, and how they fit exactly into what you're offering as part of the insurance product?
Sure. So GRMF is a really good example of one of the interventions that is already established, and people operating in East Africa will be familiar with it. GRMF has, I would say, been a partial success. There is a detailed analysis in the Geo Futures original report that we did for US Energy and Power Africa. But I think it's safe to say that most developers have found it quite a rigid process and quite a burdensome process to apply for GRMF funding. A lot of projects have been actually told that they will get some GRF funding, but very little money had gone out of the door to developers. And this is because the GRMF pays after certain milestones have been, or a lot of milestones have been reached. And for developers, that's tricky, because you've got to fund all the work to reach those milestones. So there is some question as to how much money the actual GRMF program raised, because developers need the funding up front to undertake the work. So, and also GRMF does not cover all activities. So for instance, infrastructure costs were not eligible under GRMF, and there is quite a significant co-financing required for GRMF at the different stages. So the Geo Futures is designed exactly to sort of complement what GRMF is doing, and that means that the Geo Futures funding will be made available up front, still on a milestone basis, but it'll be dispersed upfront and in stages to enable projects to finance the work they need to do to move the project forward. So that's a crucial difference. And we will also look at making finance available for the infrastructure costs, which GRMF historically hadn't done. So those are two important differences. Where GRMF has been successful, it has actually created some discipline in the project development pathway. It's sometimes been criticised for putting too much discipline into that pathway and been too inflexible, but it has ensured that good project development has been taking place. So GRMF is it has its flaws, but it has had some successes as well, and it has been useful, and it has laid the groundwork for us to be able to make Geo Futures available in the future.
Okay, it meant very, very interesting. And in the context, I mean, GRMF is actually just one example. There's the GDF program with in Latin America, which actually also faces the issue is that either you need to match the funding or put the funding up front, which doesn't really help the projects get off the ground because they still need to raise the full amount of money, right? That's a big challenge.
Correct. So often those financing or those instruments are sort of seen as bonuses. If the project is successful at the end, you do get your money back. But if it's not successful, or you've not you've got to finance it to get to that point yourself anyway.
Here are a few questions in the chat room with regards to the geographics. You mentioned Ethiopia and Kenya now being, I guess, both for the insurance and the Geo Fund, Geo Futures Fund. Yes. Are you looking also at different geographics, let's say Indonesia and others?
So for the insurance itself, we are open to projects anywhere in the world. What we say for the insurance is we're interested in the geology, not the geography. Okay, so as of today, we could look at projects in Indonesia, Mexico, East Africa, the Malassa Basin, the US. We're not geographically constrained. That said, we do have to ensure that there are willing local insurers to work with us, because those countries will often have regulatory requirements that require domestic insurance policies to be issued up front. And then those insurance policies can be ultimately reinsured into the markets that we work with. And we have been working a lot with the international specialty risk insurance market, which is, has been my day job for nearly 30 years, to give them an understanding of geothermal energy and what their role could be in providing this insurance. Because there's not a lot of understanding in the insurance market generally about geothermal, and in fact, where they have had some participation, it's often been providing control of well coverage for geothermal projects, and we know that a lot of insurers are actually pulling out of geothermal because the underwriting results have been bad. However, we have a number of selected insurance partners that have been willing to collaborate with us and are willing to accept the resource risk product that we've defined. For Geo Futures itself, yes, we are focusing on East Africa. However, we are also looking at making it a global emerging markets fund. The Green Climate Fund cannot provide capital for developed countries, so projects in Europe or North America, etc., would not be eligible. But we are interested in looking at rolling it out to Asia, Latin America, and the Caribbean. So if there are project developers there that would be interested, please do contact us. And if we can see sufficient demand and prove sufficient demand, we would certainly be happy to look at how we roll that out.
Okay, but kind of on the geographic side, so clearly, I mean, I was reading out the list of countries that you mentioned, that these were all kind of high temperature resources, but then you mentioned the Malassa Basin in Germany, so basically you would cover both the high heat temperature resources, but also those that kind of like would be below the steam threshold for steam turbines, correct?
Yes, so we can look at the lower enthalpy projects and the sort of sedimentary formations. It is a slightly different structure, but those are we are open and willing to look at those as well. Those projects typically are, doublets, and therefore we can't get a spread of risk across a single project in terms of multiple wells. So we do have a slightly different underwriting approach to those, but we do have an appetite to look at those as well. And we've been working well with a broker in Germany who has been very active in the Malassa Basin as a partner there as well.
Okay. So yeah. Okay. Like I said, I'm trying to read here at the same time, so it's a bit challenging. So here we have some, like, I kind of want to save them a little bit, some really, let's say more detailed questions on the insurance program itself. But so the way you explained the insurance product, and also in the context of the Geo Futures Fund, is that the insurance would kick, or the insurance product per se would kick in only if you've already have done some exploration drilling. Is that the correct understanding?
Yes, we did. As I said, we don't think insurance is the right solution for pure exploratory drilling programs. So we do think it's important to have some for the exploratory wells to have been done early on. That doesn't mean that we can't get involved with the project developer and the financier at that stage to agree an appropriate program to work through it. But it is difficult for insurers to take a pure exploratory risk.
And how, I mean, and that's also one of the questions in the sense of other commercial insurances. Is the Geo Futures Fund and the insurance product that you provide kind of complementing and somewhat intertwined, or are these completely two separate things that you separate very, very clearly, or is there some kind of overlap that you can provide?
The overlap between the Geo Futures Fund and do you mean, Alex?
Yes, correct. So basically, like, you mean, so these are basically kind of like to understand if these are completely two separate things, or if there's a way where.
Yeah, they are interlinked because I mean the insurance stands alone and is available, as I said, now and on a sort of worldwide basis, subject to the geology. Geo Futures really is something that will help projects deal with that very early stage risk, that exploratory risk, by making direct funding available to them, what we refer to as Pillar 1. And then it can also provide a premium finance facility to then purchase the insurance. Because the insurance, can be, multi-million-dollar spend in its own right. And then with the Geo Futures Fund, that will give developers access to capital to pay for that insurance. So that's how these two things are linked.
I mean, if you stay on this slide here, I mean, there's also a question here. I mean, it is again in the context of the GMF, where it said that basically the GMF will only be able to pay when there's a permit for the work itself. So the question would be if the fund, the Geo Futures Fund, would already pay, let's say, on an early feasibility study.
Yes, that's where we think that some very early stage funding can be made available for Pillar 1 under Pillar 1.
And like I said, I'm trying to kind of get into all of this question here. So yeah, maybe just working down a little bit. Part of it is it's very technical. So the question was early on in the presentation on why de-risk for equity investors and not debt investors, but you kind of mentioned this then going forward, that like you would even kind of allow like debt financiers to come in earlier due to the insurance product, correct?
Yeah, absolutely. I mean, in my experience, debt doesn't really take any risk. So it's hard to de-risk something that doesn't take any risk. So, what we would do is, allow debt financiers to come in earlier. And that can be quite important and make a big difference to the cost of capital.
Understood. No, I mean, this is interesting. Okay, so then and like I said, I'm just trying to kind of go through this here. What would be the minimal deductible that insurers wanted to see in the exploration or in the drilling insurance?
It's difficult to say in dollar terms. I would say it's probably about 10% of the sum insured is the minimum. But in each instance, it's going to be arranged on a case-by-case basis. What's important for the insurers is to see that there is good alignment of interests between the developers, the investors, and the insurers. But I would say that would need to be at least 10% deductible.
Then another question here, which is also interesting. I mean, there's also in the context of development in these two pillars that you describe. So the question would also be if, I mean, naturally that probably ties into kind of who your contractual partners as part of the insurance. But here the question concretely is if in the pillar 2, which I guess is the insurance product, the question is like if if this would also be available for contractors in a turnkey scenario where you have a contractor offering a complete turnkey solution. And the question is, that would fit into that?
Yes, I mean, if someone has ownership of the risk, if they are a contractor, provided that they have an insurable interest in the project, then they would be eligible too.
Okay. Then here's another one. So if, and I'm just reading this here, if risk for equity is reduced because of the insurance, the expectation and the return naturally would go down due to the premium. Is that the correct understanding? I mean, that, and because that also goes in another question, is like exactly kind of like how much the insurance is in a sense of comparing it to the cost of a project in percent.
Correct. So, what's important? We've actually come across a number of projects that simply can't even get equity. So we designed this product to help get equity investors into the sector in the first instance. In terms of the trade-off, this will be a question on a project by project basis. And it'll be a case of, how much risk do you want the insurers to take relative to the developer and relative to the equity investor. And that will come down to a structuring question of what limits, what attachment points, what deductibles are being sought and what is appropriate. But yes, we think importantly, we need to get more equity into the industry for these projects. There seems to be a lack of it fundamentally.
This is, I guess, I mean, this is then, as you said, it's then basically just a cost that you have to accept. I mean, otherwise you wouldn't have any money to do the project at all anyway. So it's just the question is like same, like I guess the cost of raising capital, I guess. In that context, you just have to evaluate if that fits in. Okay, no, this makes sense. The naturally here the question is that you mentioned this before, the insurance would only come in if you've already done some exploration, and naturally that is the most critical part, in this pillar 1, the exploration. The insurance, you said, would never go like really that early, but the fund would be. So the question is like in how far does the fund, let's say early exploration, let's say slim well drilling, for example, to take off the risk, in those very early stages before you do production drilling.
So this is again why we developed the fund concept, because we recognized there was a lack of access to capital for that very early stage activity. We didn't think that the insurance was the right type of capital to take that risk at that very early stage. Hence, we developed this Geo Futures Fund, which brings in that additional source of capital. And do remember, this is semi-concessional capital that we're working with the Green Climate Fund. And that allows it to be made available at a very early stage.
What else? Trying to hear. So have you already applied the insurance to clients, or? And then the other question was also, has there already been a policy claim so far?
We have applied the insurance to a project, and I'm pleased to say we haven't had a claim, although I do know there was a large German insurer that tried to sort of copy this idea and emulate it. They did not have very good results and had significant losses, in fact, and therefore we believe, but we don't believe that they're still in the market. They actually, they're a very large and experienced insurer, but they made some fairly fundamental errors in our view, which was a shame because, we think that it's always good to have a market of more than one. So there has been claims, and that, in fact, a lot of those were in the Malassa Basin, because that was obviously, on the doorstep of that insurer. But we've not had any losses, I'm pleased to say.
Would you be able to name the project that is insured, or the region at least?
I can tell you it's in Latin America and Caribbean.
Okay, good. No, I mean that's I guess that's the fair question. You don't have to answer, but understandably. And actually, here's also a concrete question: exactly what would be the premium for 100% coverage? I guess that also really depends on the project and the region.
Yeah.
So
it is, of course, the question everyone wants to know, but it is rather like asking how long a piece of string is. So we would say, if you show us a piece of string, we can tell you how long it is, but there is a lot of due diligence work that needs to go into it, both on the technical level, and we work with Geothermex as typically as our technical advisors to help us develop our probability of success assessment. And then there is also the element of structuring the insurance on the attachment points and deductibles, etc. So it is all highly bespoke to the project.
Here's another question, which is naturally also interesting in the sense of how would one hedge or watch out for the exchange rate risk? I mean, that's actually also a key issue for some of these international developers. How would that fit in?
Yeah, so it's a good question. I mean, it's not part of our activity, exchange rate risk. That is normally handled in the currency markets. There are interesting developments like organizations like TCX that are trying to provide currency solutions for emerging market currencies. And I would recommend that you speak to an organization like that to look at the currency risk.
What else here? I mean, okay, that was one of the questions I had here as well. Is you mentioned some of the partners in your work, and I mean, I got to know you and the team quite a while ago. When you initially looked into geothermal together with Geothermex. Maybe could you explain a little bit kind of like how did you end up exploring geothermal as part or for an insurance product?
Sure. Well, we were approached by the IFC, part of the World Bank Group, the private sector lending arm of the World Bank Group, who sort of said, well, we know geothermal is great. It's, it's cheap, it's clean, and it's baseload. But if it's so good, why is there so little of it? And that was our first look into Geothermex, and we partnered into geothermal energy, and we partnered with Geothermex as the technical experts, and we did a risk analysis to see where the risks and pinch points were. And there are risks throughout the development profile of any project, but it was particularly this development drilling point that we saw as a really difficult financing challenge, and that's when we developed the concept of using insurance capital to limit the downside of it. So having started working in this area with Geothermex quite a few years ago now, we've been continuing to develop this as a concept, roll it out to the wider international specialty insurance and reinsurance markets, so that there are knowledgeable insurers that can provide the underwriting capital to do this. And we continue to work well with them and Geothermics. As I say, they provide the technical due diligence, and we bring the insurance expertise, and both of those are needed to make this work effectively.
I mean, in that context, I guess that's also always the issue. I mean, like, you are an underwriter, you bundle these insurance products, but you still need the capital from these insurance companies. How difficult has it been to engage with these commercial insurers in a sense of, you know, funding this particular product of yours?
It's been very difficult, and it's taken a lot of education, and that has been done by us and by Geothermics to explain and demonstrate both, you know, how it can be done, how it works, and also demonstrate the pipeline of opportunities. As I said, we've got another 4 projects in the pipeline that we're looking forward to progressing. And you know, the geothermal industry really wasn't well known in the insurance market, and where it was, yes, they can insure the power stations, relatively straightforward. You know, that's, you know, the effectively steam turbines or you know, binary systems, but and that's quite easy to insure. But this resource risk, that was a very new concept to the market. So it's been we've had to do a lot of work to bring them along, but the insurance industry can be quite flexible and innovative at times, and we're pleased to say we have some good partners that we've been working with.
Maybe in the context, a little bit biased question actually, but then the question here, the partnership with IGA and the International Geothermal Association as partner. I mean, this is naturally describes also the role of industry in a sense of supporting developing projects that help the industry. Maybe can you explain a little bit that particular project a bit more?
Yes, so you know, we think, you know, geothermal energy has huge potential, and we, which is why we sort of got into it and have been working in it for as long as we have. But to make it as successful as we believe it can be, needs a lot of collaboration between different stakeholders and with people with different expertise to deal with it, to deal with the challenges that the sector faces, and particularly to get capital into the sector to develop these projects. So our P4G award, the Scale Up Award we secured in collaboration with IGA, has been great, and it reflects that concept of collaboration and partnership, and IGA having a fantastic reach throughout the geothermal community to help us engage with developers and to make developers aware of this type of solution, and also provide us with industry insights and information that we can then share with the insurance industry and bring them in as a collaborative. That's, you know, that's the pool of capital we're trying to mobilize and bring into the geothermal sector. And so, you know, we were really pleased to get this P4G Scale Up Award earlier this year, and there's an interesting program of activities that we have lined up with the IGA over the next 12 months, where we will be, you know, hopefully when we're able to travel and do some of these events in person, they will be continuing to engage more broadly across the geothermal sector.
Well, I mean, there's probably quite a few more questions that I'm likely gonna miss here. there's one additional here that I thought is also interesting in the sense of the context of the development team, the expertise, and so on, and the capabilities. How much does that tie into the insurance per se, or then I guess also for the investments of the fund?
Yeah, well, you know, this is why we have trusted technical partners such as Geothermal to work with, that bring the technical geothermal sector knowledge, and they have a broad range of skills: geophysicists, geochemists, drilling engineers, and so on. And we rely heavily on them. And we bring the insurance and finance investment, and between us, we are able to make this work effectively.
Excellent. I mean, there probably would be a few more questions, but I think we pretty much leave it at that. We could maybe then move on to the next slide, but I would very much like to thank you, Julian, for the presentation. And the insights. There will definitely, I guess, be more follow-up questions, and I would assume that people can find you and your company on LinkedIn or on the internet. So if there are questions, they can follow up with you directly.
Our website is parhelion.co.uk, and I think there is also some information on Geo Futures on the IGA website as well. So you can contact us through IGA, or you go directly to our website, and I am indeed on LinkedIn as well.
Wonderful. No, thank you. Thank you so much, Julian, for taking the time to do this overview introduction and open the floor for questions. Thank you very much. And with that, I just want to point out to the next webinar, which will be next Friday with Professor Ernst Hünges from the GFZ in Potsdam. That will be a webinar in German led by Jochen Schneider on geothermal systems and environmental impact. Or actually, it might be in English as well. I don't know. But with that, I wish you a great weekend. Thank you very much for joining the webinar. And Julian, again, thanks to you, and have a great weekend.
Thank you.
Bye.
Bye-bye.